The insurance disaster trade. To the 1 in 1 million investors, like the Katusa alligators reading this, it will be the start of some of the most critical talks in the global markets. Many investors and historians could very well point to November 2021 as the catalyst date that put World War Z into motion. Expect all media and the news cycle to highlight reports that the global oceans, on average, are 30% more acidic and global temperatures 1 degree Celsius warmer than before the Industrial Revolution, which has resulted in a 70% decline in the population of mammals, birds, fishes, reptiles, and amphibians. To add urgency, the media will highlight that the rate of change of ice loss in the Arctic is 300% higher than the last decade. It took mankind 250 years to produce and release 500 billion tons of CO2 equivalent into the atmosphere. At current rates of emissions, it will take less than 40 years. Now I will share a statistic that got the wheels churning in my brain. 1 in 50-year climate events occurrence will increase 38.9-fold. This one line in the almost 4,000-page IPCC report caught my attention in a big way. I had to reread the whole section many times to fully grasp the significance. Insurance Green Renaissance. Before you jump to conclusions and opinions, you must know that statistic above is very important. Backed by enough evidence and math, the results will directly affect the way the insurance sector does business. The insurance sector as a whole is one of the largest pools of capital, that is non-government, in the world, and the largest provider for non-government capital for infrastructure projects globally. 2017 was a banner year of losses for the insurance companies. $140 billion in climate-related infrastructure losses. Dr. Stokes, testifying in front of the U.S. Congress in September 2021, stated that the cost of the U.S. alone in 2021 would be $500 billion due to climate and weather disasters. Another well-known insurance group, Lloyd's of London, which is over 300 years old and operating in over 200 countries, so they know how to survive, published their own calculations. Lloyd's of London believe their numbers prove that the 20-centimeter rise in sea level at the tip of Manhattan, compared to 1950 water level, increased the insurance losses from Superstorm Sandy in 2012 by 30% in New York alone. In addition, over $500 billion of coastal U.S. property could be below sea level by the year 2100. These stats are all a major risk to insurance companies' operations. You do not have to agree. Agree with the published data or not, it's presented by the top firms in the world, and the biggest insurance companies in the world have taken note. But it's not just politicians that had their say at COP26. Let me explain. The Bank of England, the central bank of the UK, is the force behind the UK being a global insurance powerhouse. This editorial isn't about insurance or actuarial science. Actuarial science is the math that can calculate with incredible accuracy when we will each die when the insurance premiums are written. So please bear with me on some minutiae that will really shock you and help you understand where the flow of capital will be going over the next decade. The Insurance Market 101. The UK is the single largest market for non-life insurance in the world. It's roughly about 7% of the global insurance premiums. These premiums are written through the London market, with almost 85% undertaken in the UK by insurers which are themselves part of groups headquartered overseas. Note, everyone is connected in insurance and not an island. UK domiciled insurers rank 4th globally in written premiums and managed almost $2 trillion in assets. The insurance business is so big that it will depend on open international insurance markets. Hence, sector reform and legislated reform will become a key factor in redirecting, investing, lending trillions of dollars of managed insurance assets towards reducing the impact on the climate. Meaning, to have access, one must abide by the rules. In addition, large infrastructure projects, real estate assets, and other assets will have to meet the criteria of the insurance companies, or risk the potential of not meeting the coverable criteria by the insurance company because of their carbon footprint and emissions. It would be the equivalent of an obese smoker who has had a heart attack that doesn't qualify for life insurance. Without a plan to reduce the corporation's carbon footprint, their portfolio of assets may not qualify for insurance coverage. Would you invest in such a company, for example, a REIT, a real estate income trust, if the portfolio of buildings did not have insurance coverage? Perhaps you would, but at a much lower valuation because of the risk of uninsured assets proposed to the bottom line during a disaster. The net zero movement will spare no one. The central banks and large insurance corporations are all getting behind a net zero movement. It all comes down to the cost of capital. Over $90 trillion. Yes, you heard that right, with a T. Over $90 trillion from just the financial world, that's insurance, pension, and specific government plans, has already lined up to commit to allocating that capital to projects, companies, and assets that meet the criteria of reducing the carbon footprint. I want everyone to think of the magnitude of this amount of capital. The total annual global energy spend is about $2 trillion. In addition, the IEA recently came out and stated that the energy spend needs to, at a minimum, double to meet the agreed upon goals of Paris 2015 COP. Over the past 6 years, decarbonization went from a cute idea to what will become the most highly sought after investment theme since the late 90s tech boom. Through a concerted effort, corporations and governments around the world used the 2020 pandemic as an inflection point to move from an unsustainable emissions trajectory to a sustainable pathway. The prizes and penalties for decarbonization success and failure have never been higher. You're looking at a chart now from January 2020 to July 2021. The number of companies with net zero commitments has tripled during that time frame. There's over 3,000 companies that are publicly listed that have made net zero commitments. These commitments are not backed by some fluffy long-term guidance. Financial commitments to back net zero targets have soared 18-fold to over $88 trillion during that same time frame. The corporations have committed with their balance sheets. The largest and most powerful investment institutions in the world are heading in the direction of decarbonization. And I believe the UK government will make a big commitment this COP26 and even go as far as to start legislation towards a decarbonization framework, meaning making it law. This movement will impact all your investments. This was a big talking point in the last chapter, the forbidden chapter in my book, The Rise of America. Corporations that are not willing to make changes simply won't attract new investor capital. Worse, many current investors will be forced to sell out. Companies who don't want to play by the new rules will face much higher costs of capital, which in turn will render them obsolete and uncompetitive. Aggressive shareholder activism will continue for those companies who don't want to play ball. Again, the cost of capital goes up for those not willing to make changes. This is the new normal. I cover carbonomics in great detail in my premium research service, Katusa's Resource Opportunities, as well as the energy and precious metal sectors. And it's read by everyone from novice investors to some of the most prominent family offices and fund managers in the world. Stay safe. Subscribe to the KRO, which is a Katusa Resource Opportunities, to find out exactly what prices I'm buying at and what price I sell at before the trade occurs. And you get to sell before I do. If you want to give your portfolio an edge, consider becoming a member and giving it a try for yourself.